Hey everybody, Tim Doehrmann here, and I am back with part 2 in my series of taxes in retirement and things to look out for, and just basically understanding of how our tax code works, a little bit of history on it, and how it's going to pertain to you in retirement. So today we're just going to start with a real high level view. Taxes 101 is what I call it. So basically what we have in our country is we have 7 different brackets or 7 buckets, okay? And I might interchange those two. I might say buckets or brackets, but I mean the same thing. So we have seven brackets of regular income tax, and then we have 3 buckets of capital gains preferred dividends, which are preferred rates and are a little bit lower than our ordinary income. And then we have deductions and credits. And we're going to talk a little bit about each one of those today. All right. So first, right now, as I mentioned in a previous video of the history, our tax code originally in 1913, when we first implemented a income tax, had 7 brackets, right? Same as today. But they used to be 1, 2, 3, 4, 5, 6, 7, and then today they're 10, 12, 22, 24, 32, 35, and 37. So quite a bit difference, right? And those are basically the highest rates in our current code, right? And then the rise and run of each is different too. So intuitively, a lot of times people think, hey, maybe all the brackets are similar size. That's not true. And obviously the jump between 10 and 12 is a lot different than the jump between 12 and 22. If you want to think of it as like maybe you had a carpenter build stairs for a back deck or something. Well, if your stairs look like the rise and run of our tax bracket, then you would definitely fire that carpenter because they're not even close to being the same. So anyway, but right now that is how our bracket system works. Okay, and then also we have what is known as a marginal tax rate, which basically means that only that last dollar was taxed at whatever rate you're in. So that's why sometimes your effective or your average rate is quite a bit different than if you're like, let's say you're in the 22% bracket, but your average or your effective tax rate might only be 14 or 15. And the reason for that is after your deductions, each bracket is only taxed in that bracket. So 10% is charged 10%, 12% is charged 12%, and then whatever bumps into the 22% bracket would be taxed at that rate. So if you had $1,000 bump into that 22% bracket, you would pay just that $1,000 at that 22% rate. So that's what marginal means. Okay, now on to capital gains and qualified dividends. And they get a little bit different treatment because what they're basically, this code is made to incentivize investments. Okay, they want to encourage investments in the economy. They want to try to help people help themselves as far as it pertains to saving for retirement and using their money to work for themselves, right? So they made this part of the code, and they gave us a little better treatment, actually quite a bit better treatment for capital gains and qualified dividends. And what we have with this system is a 3-bucket system as opposed to our 7 regular income tax brackets, right? And these, the equivalent is, first we have 0 all the way up to about 89,000 or 90,000, just thereabouts. And that's about the same as kicking into the 22% bracket as the ordinary income. So basically we have 0 in the capital gains all the way up through the 10 and the 12% bracket of regular or ordinary income brackets. And then the next bracket of the capital gains and preferred dividends is actually 15%, and it kicks in about the same time as the 22% bracket on the ordinary income side. So it's quite a bit less than that too, and that goes all the way up to about 550,000. And all these terms I'm talking about when I'm talking about the threshold, I'm talking about married filing jointly. But if you're an individual, just basically cut it in half. That's how our brackets are basically set up right now. But our capital gains go all the way up to 550,000, a little bit more than that actually. You're only paying 15%. And then they cap out at 20%. So if you're over that, then you're only paying 20%. So pretty big difference considering our ordinary income rates top out at 37%, right? So these are definitely preferred brackets. And in order to get them, basically you have to have dividends that are domestic. So long story short, that's kind of how it works. And then in order to get to the long-term capital gains, you have to have an investment held for at least a year. And then the rise and run too of these is very big. As I said, nothing even kicks in until about 90,000. You're in the 0 rate for the capital gains, and then the 15% of capital gains goes all the way up to about 550,000. So a very, very big step, if you will. And then next, what we have are deductions, exemptions, and credits in our tax code. And this is the kind of stuff you're going to see on your 1040. But basically, they are all just different ways that are going to reduce your tax bill. Right. And first I'm going to start with exemptions, which exemptions are gone, right? Since the TCJA, Tax Cuts and Jobs Act, they basically did away with exemptions, which we used to get just for basically being live, but I'm not going to go into a whole lot of detail with those because they're gone right now. But then we have deductions, right? And deductions are as big as they've ever been, you know. Right now, if you're married filing jointly, it's your standard deduction is $27,700. And then if you're over 65, you get another $1,500 per person. So you're going to be able to save, or your deduction is going to be $30,700 if you're 65 plus and filing married. So that's a pretty big deduction, right? Over $30,000. And right now, because our standard deduction is so high, only about 10% of our country is actually itemizing because our standard deduction is so high. So that's a pretty good thing, right? Kind of makes things easier for tax preparers, but they still have to check everything, right, to make sure it makes sense. Okay, and then also credits. Now, dollar for dollar, a credit is better than a deduction because a credit is actually going to reduce your tax bill by that amount. A deduction is just going to reduce the amount that actually gets taxed. So dollar for dollar, credits are better, and they put credits into the tax code to basically incentivize behavior. So they have like healthcare tax credits. They want people to make sure that they've got healthcare and all this stuff. We want to be making sure that we're taking advantage of all these things during our gap years, which our gap years are years between retirement and when RMDs kick in, or required minimum distributions. All right, so that wraps up Taxes 101, and the next video will be Taxes 201, so stick around for that. Once again, Tim Doehrmann here, founder of Eagle Ridge Wealth Advisors, and if you would like to see how we help our clients get the most out of their financial lives in retirement, please visit us at erwealth.com, and we hope to see you there.